Shares in mining and commodity trading house Glencore are down more than 70% since the group's first profile listing in 2011. This week, it announced plans to issue a $2.5 billion in new equity, halting dividends, selling assets, and cutting capital expenditure. This is all part of their plans to pay off $10.2 billion in debt. But in studio with me to discuss the challenges that are currently faced by Glencore is Finweek editor Jana Marais. Jana, thanks so much for your time. It was interesting, the statement that came out this week by the chief executive of Glencore. He said he was a lot more bullish than what we thought shareholders may be. Do you get a sense that maybe he thinks that these cutbacks may be a little too excessive?
Look, I think it's very clear that he didn't really think it's necessary to go that far. And he mentioned that he thinks, that shareholders said, look, commodity prices are going to fall a lot further. His view is not that that's not the case. He had an interview with one of our reporters and said, it can't really fall much further, and even if it does, it's going to be a short-term situation. He mentioned that they've seen an uptick in demand from China for the second half of their financial year. And he used the example of copper, saying, the prices have been under so much pressure and declining, but they actually see a 2 to 3% increase in copper consumption globally. So he's certainly more bullish than it seems his shareholders are. The Financial Times had quite a hard-hitting column on him saying he's a mogul in denial. So who knows? I suppose we'll have to wait and see what prices do. But for now, if the shareholders speak, you better get your ducks in a row. So they are continuing with these cutbacks.
They are definitely very much invested, and by that I'm talking about the chief executive and his management team. They're big shareholders. How much is this cost raising or this cost cutting exercise going to cost them, and are they going to be participating in the equity raising?
Yes, I think maybe that's part of the reason why he's not so keen on this massive equity raising, because I think Glassenberg's stake is just over 8%. It's going to cost him $210 million to maintain his stake in an equity raising. I think they're planning $2.5 billion at this stage. And if you look at the top 5 guys in Glencore, it's over $500 million to maintain their 20% stake. So it's big numbers, not money that me and you know anything about, to me, unfortunately.
Yeah.
But then on the other hand, they've had a phenomenal run, and you can just imagine what they've been earning in dividends. So the next 2 dividend rounds, the final dividend and interim for 2016, those are both suspended under this program. So it's clearly not it's a bit of a tough time for Mr. Glassenberg himself as well.
Definitely tough times. And Jana, if you look back at the time when they listed, they said one of the benefits of Glencore is the fact that they've got these big trading operations, and this is going to act as a buffer for when the times or the tide does turn. What went wrong?
Look, I don't know if we can say what went wrong, though. If you look at their share price, the shareholders clearly won't agree with me. But I think we must keep in mind that trading and mining are 2 very different businesses. And Glencore, at its heart is very much a trading business. Glassenberg and his top management team, they're all ex-Glencore people. And the mining operations really came mainly part of the Xstrata deal that was done in 2012. And I think if you look at trading, it's a high volume, low margin business. You don't need much capital on the balance sheet. If you look at mining, it's long-term, capital intensive. You need a strong balance sheet to actually get you through downturns like they see now. And maybe that's why they are actually in a bit of trouble on the balance sheet. Their net debt is now more than their market capitalization, and that's not a situation anybody wants to be in. And I think the other thing that might be worth mentioning is that when mining companies like Sibanye can go bargain shopping,
yes.
Glencore has to cut back and raise equity. So you might ask, was it the right thing to let Mick Davis go when they bought Xstrata? Maybe they needed somebody with that kind of mining experience, at the top. But so they're in a mess, and they need to get out of it. So we'll see how they do that.
Okay, they've got to adapt to the times. Thank you so much, Jana. That was the Finweek editor, Jana Marais.